A formal hi to every one of you. This is Akshara Menon from PMS Bazaar. A warm welcome to the first webinar for the 2025. And before we could go into the webinar, I want to wish you all a very happy new year. And also for encouraging us throughout for the in the year of 2024, where we could do 35 plus webinars and also having 15,000 plus participants joining us and encouraging us throughout. And this is giving us an hope and encouraging us to do more insightful webinars for the participants. And coming on to today's topic, which is on what's next for small and mid caps. It's more timely and also very interesting topic. And to talk on this, we have Mr. Balaji Vaidyanath from NAFA Asset Managers. Hello, sir.
Hi, Akshara. Happy New Year.
Thank you, sir. So just two lines of brief about the speaker of the day. He's a CEO, CIO, fund manager from NAFA. He brings over 2 decades of experience in equity research. Also, he started his career as a research analyst and moved into fund management. He has spent over 7 years with Sundaram Alternates as well. So today at NAFA, he's managing over 450 crores. To be very precise, around 483 crores as of December in asset under management. So over to you, sir.
Thank you. Thank you so much, Akshara. Good evening, friends. Thank you for taking the time out and being part of this webinar. And it's a pleasure to address you all. And before I do that, I wish you and your family a very happy and a prosperous and a healthy new year. So as we step into 2025, if you just kind of look back, say the last 3-4 years, of course, minus the health-related impact of COVID, we've had stellar markets on the equities. We've had, very, very minimal disruption to portfolio returns. People have compounded their wealth very meaningfully over the last 3 years or so. And in the October of 2024, last year, we probably saw the first sign of correction after almost 4-5 years, reminding us that equities are a very non-linear asset class and corrections of 10-15% at index level are par for the course. Certain interesting aspects played out as far as this correction is concerned, which I'll come to. But our focus today is on the mid caps and small caps. How do they stand? And the NAFA way of looking at mid caps and small caps, the way we look at stocks and ideas in these type of market conditions. So I will allow me a minute. I'll jump on to my quick slides. Moving on to calendar year 2024, that is last year. We have a situation where in terms of 2024, we have seen what this table shows is the Nifty 100. The Nifty 100 essentially is a combination of Nifty 50 plus Nifty Next 50. It's broadly a large cap index. And if you look at the Nifty 100 index, we are talking of the return profile, for calendar year 2024. Close to 63% of the stocks gave a return anywhere between minus 25% to plus 25%. So 2/3 of the index, 2/3 of those 100 stocks gave a return between minus 25% to plus 25% for calendar year 2024. As we move down, here I'm just showing you the Midcap 150 index, which obviously comprises of the midcap stocks. And here, if you look at it, the number of stocks that gave a return of minus 25 to plus 25% is about 57%. In the previous slide, you saw that 63% of the stocks gave a return of between minus 25 to plus 25. In the Nifty Midcap 150, we have 57% of the stocks that are given a return between minus 25 to plus 25. This is Nifty Midcap 150. Going down one notch further, in the Nifty Small Cap 250, which comprises the Small Cap 250 stocks, only 46% of the index actually gave returns between minus 25 to plus 25%. So as you keep moving down the cap curve, the dispersion in the returns kind of increase, the tail increases. So it was around 63% in the large caps, it is around 58% It was 57% in the mid caps, and in the small caps, it's about 46%. So when it comes to mid cap and small cap, this data essentially points to the fact that stock selection plays a key role as far as selecting your winners are concerned, as far as mid and small caps are there in the markets. So over the last 3 months, we have seen an extremely volatile markets. We have seen corrections, individual stocks correcting 40%, 50%, etc. So how do we now at NAFA, try to initiate a thought process or initiate a particular buying idea? So here, I'm just giving you an example of how this kind of works, where we are trying to say that we are looking at companies and we have classified them into various sectors, and we have classified them into 4 buckets. So the stocks that are giving returns less than, when I say, we're not talking about stock price returns, we are talking about the profit growth. So stocks that have returned profit growth of less than 0%, that is one bucket. 0 to 10% is a second bucket. 10 to 20% is a third bucket, and greater than 20% is the fourth bucket. So here, so on the right side, you have the previous quarter numbers, that is for April, May, June. And on the left side, you have the recent quarters numbers, which is July, August, September. So I'd like to kindly, request you to focus on the footwear sector. So if you look at the footwear sector, which we have highlighted in red, you have a situation where in the previous quarter, there were 5 companies that reported less than 0% growth. There was one company that reported about 0 to 10% growth. There were no companies that reported between 10 to 20%, and there were 3 companies that reported growth of greater than 20%. So in all 5 plus 1 plus 0 plus 3, there are 9 companies. So essentially, you want to be in the last 2 buckets. You want to be in companies that are growing in the 10 to 20% bucket or greater than 20% bucket as much as possible. And you would like to avoid those which are growing at less than 10% kind of a bucket. So in the previous quarter, you had only 3 companies, that were growing at greater than, 20%. So when you come to the current quarter on the left-hand side, the same data has changed, right? So you have 4 companies which are now growing greater than 20%. So out of 9 companies, there are 4 companies that are growing greater than 20%. In the earlier case, out of 9 companies, only 3 companies were growing greater than 20%. So this is like a starting point to see that something has changed in the footwear sector. So that's how you first step into the stock selection aspect as far as the portfolio is concerned. Once you come down, then you look at the stocks. There's a rough non-exhaustive list of the footwear stocks that are listed in the market. And here you get to see that if you take the case of something like a Bata, previous quarter YOY. Remember one thing, markets are always about delta change. Markets are not always about the absolute numbers. It's about the delta change. Delta change matters more than the absolute numbers. So I can have a company that generates a 30% ROE, but it can still underperform a company that moves its ROE from 8% to 14, 15%. Whereas the company with a 30% ROE, if it were to fall to even a 28 or a 27% ROE, there are chances that the company underperforms another company which has just a 8% ROE, but it has moved to a 13, 14% kind of an ROE level. So delta change matters more to the market rather than absolute numbers. So in the case of Bata, what kind of delta change that you see? In the previous quarter, you had the company's top line growth at -1%. The company's EBITDA growth was about -23%. So now you come to the current quarter, the sales growth is about 2%. So what was -1 has changed to 2%, and EBITDA growth of -23% has moved to -4%. So although the EBITDA growth is still negative, there's a significant delta change, from -23 moving to about -4%. Then it warrants a greater look. So for companies that are basically in this type of business where the earnings are in a depressed kind of a cycle, the PE may not really reveal the true picture in terms of where exactly the valuations are. So the first starting point is always on the top line. So if you look at the top line, one way of evaluating top line is price to sales. And if you look at the price to sales of Bata, you can see that there has been a significant deterioration in the price to sales to almost like a decadal low kind of level, in terms of price to sales. So this is like a good starting point where there are signs of delta change happening in a company, and it is supported by reasonable valuations because the stock has been already reasonably punished, because the price to sales from a high of almost 14-15 times has dropped back to about 4.5 times, which was the kind of price to sales the company was obtaining around 10 years back. So this is also kind of vindicated that this exercise that we did in Bata was sometime in 2024 November, about 2 months back. The price was around 1362, and if I'm not mistaken, today the price is around 1450 or something like that. So the point is that in a huge market correction that we have witnessed over the last, say, 2 to 3 months, where individual stocks have fallen by anywhere between 10% to 40-50%, you have a stock like Bata which has kind of stood steady, and we were able to identify this ahead of time in the sense that the numbers were visible, the delta change was visible, and this is a very key aspect when it comes to selecting the mid cap and small cap companies from a portfolio point of view. So what did they highlight in the earnings call? They spoke about revenue growth of 2%, which is slightly better than previous quarters. They were actually a sales mix and inventory clearance efforts. So it was more like a one-time nature, because inventory clearance is not like a continuous thing; it's more like a one-time thing. And therefore, once the inventory clearance aspect is done away with, the gross margin contraction of 140 basis points is not going to exist in the coming quarters. That itself is a huge positive, and one can expect sequential improvement as far as the financial parameters are concerned. So the numbers, the narrative, valuations, all three are matching, and therefore, does it warrant a position in a company like Bata? Probably the answer is yes. If you look at it that way. So this was just an example. I will come to further examples later, but I'm just going back to markets. And markets, you have seen a situation where there's been a significant drop, as I mentioned, and many reasons are being attributed to it. There is FIS selling. There is, of course, US elections and the subsequent results. Not only US, there were almost 60-70 countries that went into elections this year. And in many countries, the incumbents actually lost the elections, or they lost a significant amount of vote share to the rivals, basically. You also had the regulator clamping down on speculative activities. You had an high inflationary environment impacting especially the vegetable prices, and you had the macro noise related to yen carry trade. And we're talking about the overall economy slowdown, where GDP plunged to around 5.4%. So these are all some of the reasons that are being attributed to markets actually falling. But the beauty in this particular cycle, so far at least, is that you have a situation where typically when the markets fall, it is the mid caps and the small caps which take a brunt of the bashing, and large caps typically outperform the mid and small during down phases. But we are now seeing a very peculiar situation where the Nifty 50, the top 50 large cap companies in India, have actually fallen more than the mid cap 150 and the small cap 250 index, right? So on a 3-month basis and on a 6-month basis, I mean, this is when the corrective phase actually started, and you would expect that the mid caps and the small caps to fall even further. But on the contrary, you have seen that the Nifty 50 has actually fallen more than the mid cap and the small cap index. Is this like a one-off, or is there a reason for it? And also the typical hiding places, right? So what is considered as a typical hiding places, or the so-called defensives, is that people look at consumer and FMCG kind of sectors to be hiding places, and even that has not been spared. You've had the FMCG stocks actually fall quite a bit in this carnage. It has not really acted as a typical hiding place like how it used to act in the previous falls. So it's a slightly peculiar case. So why is this happening? So if you dissect the data and if you look at other aspects, maybe we can find some answers. So there is something called as profit pool, and if you look at the profit pool, uh, assume that we are in the year 2000, the beginning of the year 2000. You had very low four-wheeler penetration in India. You had very low, two-wheeler penetration in India. As a population, we were significantly underbanked, and the IT sector, the IT services sector was just beginning to boom. That it was that kind of a phase which was there in early 2000s. So it was very easy for someone to adopt a top-down approach in the markets and buy the top 30, 40 companies in India for wealth creation. You could buy the topmost automaker of India, or you could buy the top two-wheeler maker, or you could buy the top banks, and automatically there would have been wealth creation that would have happened because of significant underpenetration in those respective segments. And a lot of those segments were also consolidated. There were not many players. They were basically duopolies, oligopolies. There were like 3, 4, 5 large players who were dominating the entire industry market share. This was the kind of situation that was prevalent. Now, fast forward to 2024, what has happened is that you have a situation now where if you split India into India 1, India 2, India 3 being the bottom most from a point of view of income and lower income segment. Even India 3 today has a two-wheeler. Similarly, if you look at the car penetration in urban India, that has also gone significantly higher than what it used to be, say, 25 years back. And as a population, today everyone has some form of bank account, regular bank account or small savings account or something or the other. People have a significant amount of financial penetration that has happened. But how much of the constants of Nifty have changed? The constants of Nifty has more or less remained the same over the last 15 to 20-year period, while all these aspects have changed. So whereas what is happening on the outside of markets, on the unlisted space, you're seeing that top companies in India that are not listed, but they are actually showing a remarkable amount of growth, right? So, for example, we have taken some US multinational companies that are not listed in India, but they are present in India, and we have just compiled their turnover that they make in India. Mind you, this is just the India turnover, not the global turnover. Global turnover is, India's turnover is just a fraction of their global turnover, as we all know. And even their India turnover today is quite significant. Like, so this dated by about 6 months to 1 year, depending on the company. So that today Apple will be close to 65,000 crores of turnover, right? So you'll have Microsoft at 25,000 crores. Your Dell is at 31,000 crores. Your YouTube revenues in India is about 15,000 crores. I was reading yesterday. And companies like Google are growing at a very fast pace. So if we look at the CAGR, 3-year sales CAGR and 5-year sales CAGR of some of these companies, although they are large caps, they are growing like a typical mid cap and small cap as far as India is concerned. So what does that mean? So if Cognizant or for example, if Google India operation were to be listed in the Nifty 50, by turnover it would rank the 31st stock of Nifty 50, right? So Apple would be ranking close to number 20 in Nifty 50 if it were a listed company in India. So such is the kind of scale that these companies have achieved in a very short span of time. Facebook again is nearing a 20,000 crore mark. So if you look at the unlisted US companies, they have grown at about 22%, and the 5-year sales CAGR is about 16%. And if you look at the FANG companies, the top 5 companies in India, their sales CAGR is 40% in terms of 3-year basis, and on a 5-year sales CAGR is almost 34%. So why I am presenting this data is to just kind of show you that the general tendency is for a lot of market participants to say that, look, mid caps and small caps have had a great run. Therefore, cut down your allocations and move to large caps. So my humble submission is that it's not hunky dory as far as large caps are concerned. So today's large caps, as represented by Nifty 50 or Nifty 100, do not really have the large caps that are actually growing in India. Okay, so the bulk of the growth are coming from outside of uh, the listed space as far as large caps are concerned. But as far as mid and small, the bulk of the growth is actually coming on the listed space, because earlier on in the mid and small cap space, you had non-compliance, no GST compliance, a lot of unorganized corporate governance issues, and so on and so forth. Now, you have from non-compliance to compliance, non-GST to GST, corporate governance issues are slowly getting better. And the investable universe is even more. A lot of new age sectors are getting listed, which get classified as mid caps and small caps. So to take a blanket view and say that mid and small has outperformed, therefore I go to large, we have to remind ourselves that our large cap is not like NASDAQ. For us to just get into large caps and think that it's going to give a return like a NASDAQ like return. No. Our large caps contain old, tired stocks, which are kind of struggling. Each and every sector in the large cap has their own challenges, which I will come to later. Therefore, to cut down exposure to mid, small, and move to large would not could not really be an ideal situation in my humble opinion. So just to give you an example, right? So if you take the largest company, which is listed in India, it's Reliance Industries, and you're talking about capex. So Reliance Industries is known for the petrochemicals, and significant portion of their revenue still come from the petrochemical sector. And if you look at the amount of capex that is being done in the petrochemical space, which would obviously result as a competition to Reliance Industries. You have Nayara, which just announced $8 billion capex yesterday. You have the oil marketing companies like HPCL, BPCL, IOCL. You have giants like ONGC also investing in petrochemical. So the petrochemical capacity itself is expanding. So what will happen to the number one player in India if petrochemicals keep on expanding like this? That's a question mark that I would keep it to you for your thought. So, and mind you that when you have a weight of 10% in Nifty, and when there is significant amount of competition coming on the petrochemical side, what can happen to the largest player? That's a question that we need to ask ourselves. And then you come to something like the FMCG sector, which has an 8% weight as far as the Nifty 50 is concerned. This weight used to be about 12%, and it has since dropped to 8% thanks to some relative underperformance of the FMCG. And we did a quick con call transcript check, and over the last quarter, the mention of quick commerce by the traditional FMCG companies has just galloped. It's exploded. So the disruption as far as this is quite real. Significant amount of urban population, and now a significant amount of tier 2, tier 3 population is also beginning to use and experience and like the convenience of quick commerce. So what is happening is you had a fragmented distribution setup as far as FMCG is concerned. So if you are a very strong FMCG player, you had more bargaining power over this fragmented distribution setup. Now the fragmented distribution setup is getting consolidated. So if you look at the working capital of FMCG companies and the margins of the FMCG companies in the Nifty 50 in the large cap space, they were quite, a lot of companies had negative working capital cycle, and they were enjoying the significant benefit of having the working capital on their distributors' books. Their books used to be very light. The balance sheets of the FMCG companies in India is extremely light. The inventory used to sit on the books of the distributors. So now, as quick commerce gets more and more better, and there are new larger entrants getting into quick commerce. We've only seen the likes of Blinkit, Instamart, Zepto, etc. So now after Flipkart Minutes and Amazon and Tata and all these other players also coming in and pouring billions of dollars into this particular space, the bargaining power of the distribution fraternity is going to increase. And obviously they are not going to, so which means that at some point questions will be asked, in terms of whether this kind of working capital bounty that these FMCG companies have enjoyed so far, will it continue to last like this? Or will the FMCG companies have to carry more and more inventory on their books? Or will the kind of margins FMCG companies are making, are they going to sustain? Or by virtue of giving more discounts, so that as a customer opens an app, all these traditional products also need to be sold, because you have a lot of direct to consumer brands that are doing very well. I mean, you look at the behavior of Hindustan Unilever over the last 6 months will tell you the story of FMCG, right? So they're trying to buy a D2C brand like Minimalist for 3,000 crores. They're trying to go and help the Kirana stores by bypassing the distribution channel, and so on and so forth. So there is a bit of a worry, I would say, as far as FMCG is concerned. And this particular sector has a 8% weight in Nifty with a starting P of around 50 times. It is definitely not cheap as far as the FMCG is concerned. Then, if you come to something like, say, the paint industry was a very, consolidated industry. You had 4 or 5 players, Asian, Berger, Kansai, Axo, and probably Indigo. You had about 4 or 5 players. And suddenly the number of players have doubled. You have Pidilite, Astral, Birla, JSW, MRF, and all these players getting into paint. So whether these new guys are going to win or not win, that's a different ballgame altogether. But initially, can there be pressure on these companies? If these companies, the newer companies are going to nibble on the market share of the existing companies, will it lead to some kind of time correction and price correction? So these are the questions that we need to ask. And this is true of almost all the Nifty 50 companies, whether it is IT, you have the listed IT players, TCS, Infosys, Wipro, Tech Mahindra, HCL on the Nifty 50. And then you have the GCC. So GCC players, none of them are listed. So today, if you open the paper, I saw that Eli Lilly is going to set up a GCC in Hyderabad. Eli Lilly is one of the largest manufacturing companies in the world, and they are setting up their own GCC in Hyderabad. So most of the companies trying to set up their own GCCs. GCCs were at one point in time cost centers. Now they are becoming profit centers. And as we see more and more GCCs, then what happens? And with the advent of Chat GPT and use of AI, etc., will the big order wins sustain? And if they sustain, will it be at the same kind of margin levels? Or will it be at the same kind of resource levels? These are all questions that we need to ask ourselves before getting into Nifty. Again, in banks also, we have this similar issue. We have a lot of these, non-banking, non-lending financial companies that have gotten listed over the last 5 to 7 years, 10 years, that are not part of Nifty, but they are also generating a significant amount of profit growth, be it the AMC or the wealth management or the broking. So this is just an exercise that we have done, that where sector rotation and the importance of sector rotation as far as the portfolio is concerned. So if you look at the data, we've just kickstarted the data from CY14, that is calendar year 2014, to give a 10-year perspective. So if someone, so there are totally 41 sectors in India. This is going by the IISL classification. There are about 41 sectors in India. So on a 1-year basis in calendar year 2014, about 26 sectors outperformed. 26 out of 41 is a 63% outperformance. On a 3-year basis also, 26 sectors outperform. When I say outperform, these are all the sectors beating the market. again 63%. When you move to a 5-year basis, only 18 out of the 41 sectors outperformed, which is 44%. And on a 7-year basis, it's 54. And on a 10-year basis, 49%. So only 1 out of 2 sectors outperform the markets over a 10-year time period. So this thing about having a very, very long-term view also need not necessarily be helpful, in the sense that the average period of consistent outperformance is about 2.8 years in India. And the average period of consistent underperformance is about 3 years. So after 2.8 years, the sector stops outperforming the market. And after 3 years, the sector stops underperforming the market. So this is like a situation where, which highlights that, like, while long-term compounding, that is all fine. But from a point of view of sectors, it's very important to understand that sector rotation is a key aspect to long-term wealth creation. So I'll go back into some examples and I'll talk about some of the recent entrants in the portfolio. So we added a company called Amar Batteries, and this company, we entered around 1,000 rupees sometime in April, and since then there was a good rally in the stock, followed by a good correction as well. The story of Amar Raja is about the expanding discount between the leader, which is Exide. The average discount, used to be around 10%, but now the discount is significantly high compared to Exide, where now the discount has moved to almost 50%. So it's a question of mean reversion, and if things change, so for mean reversion, does the financial support the mean reversion? The data says yes, because in FY18, Amar Raja had just a 38% market share. Exide had almost a 62% market share. Fast forward to 2024, you have Amar Raja having gained 200 basis points of margins, moving from a 38% market share to 40% market share, and Exide actually losing 200 bips from 61 to 59. So Exide has lost market share, Amar Raja has gained market share, and Amar Raja is also getting into the giga battery facility, and they're also getting into the new age business of lithium-ion batteries. Which means that from an entry point of view, the probability of having made a mistake reduces to some extent, is our humble submission. Of course, time will tell. We also added another stock called Thyrocare. I will take you through how we added Thyrocare and the thought process behind that. So Thyrocare was a stock which we bought in August around 870 rupees, in terms of entry price. Thyrocare was a company that was underperforming a lot of their peers. It was underperforming Dr. Lal Pathlab and Metropolis. So if you look at the last 6-quarter data, you had a situation where Dr. Lal grew 7.5%, Metropolis -1%, Thyrocare 5%. Again, Thyrocare was underperforming Dr. Lal in terms of sales growth. And again, 12 to 9, Thyrocare is underperforming Dr. Lal Pathlab. And you had 10%, 2%, 5%. Thyrocare was again underperforming Dr. Lal Pathlab. And in this case, Thyrocare, in all these instances, Thyrocare was doing better than Metropolis. In this case, Metropolis did better than all the three. So the first signal came to us in Q1 FY25, where Dr. Lal grew by 11, Metropolis grew by 13, and Thyrocare grew by around 16%. So whether it was a sustainable thing or a flash in the pan, the confirmation again came in the second quarter, where Thyrocare grew by 20%, and Metropolis grew by only 13%, and Dr. Lal grew by less than 10%. So for 2 consecutive quarters, Thyrocare has been actually outperforming Metropolis and Dr. Lal Pathlab. They did a small inorganic acquisition. They also moved from pay for performance. They moved to a pay for performance model from a discount structure model. And this has slowly started turning around. So we entered into it because of the fact that from the point of view of profitability, Thyrocare was making a 20 crore PAT. Metropolis was making a 40 crore PAT. So, and Metropolis was getting a 10,100 crores of market cap. Thyrocare was obtaining 4,600 crores of market cap. So, considering that Thyrocare is growing faster than Metropolis, and for Metropolis, Thyrocare having 50% of the profit of Metropolis, Thyrocare should also have 50% of the market cap of Metropolis. So, which means that the market cap of Thyrocare should be around 5,200 crores. This was our thought process when we looked at the company. So instead of 5,200 crores, we got the company at 4,600 crores. So this itself, from an entry point, gave us a lot of comfort because we were getting it at a good 15 to 18% less than what it should have actually traded at. And the PAT growth was 90% for Thyrocare, 50% for Dr. Lal, and about 12% for Metropolis. Similarly, in Q1 FY25, again, they have outperformed 47% growth for Thyrocare, 28% for Dr. Lal, and about 31% for Metropolis. So this gave us the comfort that our entry point is not wrong, and we should go ahead with the buying of Thyrocare. Why this is also important is because when you make an entry at 14th August 2024, and from September onwards, you can see that the market has actually kind of gone into a volatile period, with the looming US elections at that point in time, and the stocks about bubble in the SME sector. The regulator was clamping down on F&O and SME sector and everything. So you buy a stock, the overall market was impacted by all those type of aspects, and you have a situation where Thyrocare has outperformed even in this kind of a tough market phase, simply because of being cognizant of entry valuation, and actually tracking the market share growth vis-a-vis the competitors. So in the last 35 minutes that I've spoken, I have not mentioned a single word about GDP, IIP, or any other macroeconomic variable, because as a mid and small cap fund manager, I can't take a very top-down view when I allocate capital. So we have always been a bottom-up market. We have always seen a market where macros have been kind of challenging politically, economically, or a combination of both, sometimes geopolitically also. But there have been a lot of winners which have kind of thrived despite that. So one way of identifying the winners is to look at the market share growth. If someone is actually gaining market share, the market is rewarding those companies significantly. Similarly, when a company loses market share, the punishment is also severe. So one company that has lost market share and which has seen a significant punishment is Asian Paint. So you have seen that although the market share loss is maybe few tens of basis points, but the perception of higher competitive intensity in these type of sectors has actually derated the stock from a 80p multiple to today a 48p multiple, and a significant time correction from 2021 till date. Which means that in a roaring bull market, the stock has not performed because of issues with market share. Similarly, I can give you an example of VIP and Safari Industries, where VIP has, although both are in the travel and tourism sector, and we all know that travel and tourism has boomed like anything in India. So if someone had taken a call on travel and tourism and allocated to VIP, the kind of returns that Safari has given, VIP has not matched, because Safari has been able to grow faster than VIP. So it is not enough to take a top-down view, especially in these type of market conditions. It is better to be as micro as possible, and that is how we entered into Thyrocare. And so far, it's worked well for us in terms of the uh, 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 ability to withstand the market correction. We also entered into a company called Care Ratings. It's a recent entry only, around 1,400 rupees. I think it's below that price as of today. And Care is a very similar story. You have two MNCs, CRISIL, which is backed by S&P, and ICRA, which is backed by Moody's. And Care uh, was at one point in time growing below CRISIL and ICRA for a long phase, post Thailand FS, DHFL type of issues and everything. It was underperforming CRISIL and ICRA. But from 2024 onwards, you can see the green box that Care Ratings, in terms of the sales growth, has been significantly outperforming both CRISIL and ICRA in terms of sales growth. It is growing at 2x the leader, which is CRISIL, and it has been able to consistently beat ICRA as well. And their non-rating fee business, although it's a very small pie now, that's growing at a very fast pace of around 37-38%. So a lot of SME companies moving to Care for getting their ratings, etc., is kind of helping them. And that's one of the reasons why I entered into Care. And if you look at the discount against peers, right? So typically, discount against CRISIL and discount against ICRA, the Care, if you look at the right side chart, the discount used to be anywhere between -20 to +20% premium. That's how Care was trading in comparison to CRISIL and ICRA. Now, if you look at it, the discount between CRISIL and discount between Care and CRISIL ICRA is almost 45%. That's like a significant discount, which is unwarranted because of the fact that they are growing much better than CRISIL and ICRA. So we feel that at some point in time, markets will recognize this and give Care its due in terms of multiple. So the last example in this webinar is a company called Vimta Labs. So this is a company which we entered around recently, around 720 rupees. And, one macro theme that we are liking at this point in time is testing. So testing is something that's going to become mandatory. There's going to be a significantly higher amount of testing as far as India is concerned, with more and more quality control norms and orders coming in, more and more standards coming in. Of course, the body which is implementing all this is the Bureau of Indian Standards. They do have their own testing facilities. They also outsource a lot of testing to private players, and Vimta is, of course, a very strong player in the testing market. So anything from a jackfruit to a mobile phone can be tested by Vimta. They have the facilities for that. And, we believe that as a theme, testing could do really well. And, because, we are trying to improve the quality of the products that we consume. And we are trying to establish a non-tariff barrier and trying to make life difficult for importers in terms of making a better Viksit Bharat, Atmanirbhar, etc. And we have seen evidence where, once a standard comes into the picture, a lot of segments, the export CAGR starts moving higher and the import CAGR starts slowing down. Exports grow faster than imports once the BIS standard comes into place. We can see that in the case of cable industry, we can see that in the case of electric transformers. A lot of these instances where the BIS standard came into place 3 years ago and export CAGR moved up, import CAGR came down. So now government is trying to reduce imports as much as possible and increase exports. And BIS will play a crucial role in the coming decade. And one way to play BIS is a testing company, and we like the leader which is listed here, Vimta. Performance, I think I will end here. The performance is available on the PMS Bazaar website, the recent performance for your kind per user. So we churn about 30%, 25 to 30% in a year as far as the emerging blue chip portfolio is concerned. And the max drawdown that this portfolio has seen is around 35% during the COVID period. The other metrics like number of companies less than 0.5 debt equity is around 25 out of 38. And the portfolio P ratio, of course, is around 20 times, and 1 year forward on a conservative basis is around 17 times. Yeah, so I would like to end my session here and open the floor for questions, Akshara.
Yeah, thank you. Thanks a lot, sir. That was a very deep dive PPT, I must say. And also, that was completely relevant to what topic we were talking about, or what small and mid caps. So before we could start the Q&A, I would request the participants to, put their questions on their Q&A box, which will be answered by the fund manager. So let the questions flow in. Before that, the first question that I want to ask from your PPT, what you just spoke about, literally, you had to say, like one of your articles also said that India has moved on, but Nifty 50 hasn't. So we're typically talking about the composition in the Nifty 50, right? So if it is in an overhaul, so what kind of a composition do you expect Nifty 50 to have, in the next 10 years?
So, I mean, if you just go by the composition of the developed markets, be it Germany, France, UK, US, each and every country has carved its own path in terms of how their composition is, right? So, for example, US technology has, played a significant, is now a significant constituent in their indices. And if you look at Germany, industrials is a significant component in their indices. So, whereas as far as India is concerned, we've had a significant chemical rally, and there is not a single chemical stock in the Nifty. You had a lot of new age company listings. Only now you have a company like Zomato, which has gone into Sensex, but not yet into Nifty. One commonality, Akshara, in all these indices is one significant commonality is that the weight of the financial services has actually come down. So today
Okay.
our weight in the financial services is quite high. So we feel that somewhere the index constant, I mean, uh, Nifty 50 has a shelf space of around 50 stocks. So if you believe in the manufacturing story, R&D story, technology and new age story of India, then if those are going to get bigger, those will ideally come into the Nifty. So which means something has to give way, get out of the Nifty. So that
Got
is how I'm looking at it.
Yeah, but you were saying about the other fan companies, right? So, and their dominance in India is also predominant, right? So, if it is so do you think an investor should have a global diversification, global allocation to them rather than having it on Nifty? Just wanted to ask you that, sir.
Definitely, definitely. I mean, as the world is getting more and more global, I think global exposure is warranted. Rather than Nifty, I would say, because Indians today spend on Google, Facebook, Amazon, Netflix, and none of these companies are listed in India. The only way for you to take exposure, not only the top 7 companies, but the other upcoming tech companies, is via taking a global exposure only.
Okay, so let me ask one question from the audience side of it. So the first question was like, any drone technology stocks in your portfolio? If you want to answer it, sir.
We don't have any drone technology stocks in our portfolio. However, we are closely following a company that supplies parts to drone companies, right? So, but it's very small at this point in time, but we are tracking it. As of now, we don't have any drone technology companies because there are only a handful, and the current valuations are, quite high, I would say, as far as the drone technology stocks. Post their listing, for the kind of hype that they exhibited, they have not really lived up to that hype. Therefore, these stocks doubled and then they have come back to below their IPO price as well. At some point, some winners will emerge and we'll see at that point.
Okay, so for the benefit of time, I'll move to the next question. My other question is from Aditya. What about the mode of large caps? Are they being disrupted, the mid and small caps? Also, what about the growth of mid and small caps now? The margin expansion is behind us.
So margin expansion behind us cannot be like a very blanket thing. It really depends on the sector, depends on the company, and what the management does, etc. So many companies can exhibit margin expansion if they are able to garner a significant market share from their competitor. And the moat of large caps, that's what I explained earlier in the call as well, that now with a significant amount of weightage of the Nifty 50 companies getting disrupted, not by the mid and small caps specifically. Some are disrupted by mid and small, but a lot of them are from outside of the market universe due to various reasons. uh, I think that my humble view is that this time, if there is a correction, the large caps are not going to be spared. Even they are going to fall as much. So if somebody thinks that large cap is a hiding place, that may not really kind of work out, in my humble opinion.
Okay, got it. So one more question on that is that there are very few fund managers who going to go meet the company management. Generally, the data is all out in a tap of an internet. That's it. So you're one among the fund manager who meets the management. Don't you think that would create a biasness? What are your thoughts on it, sir?
It does create a bias, but it's more for academic purpose rather than anything. You don't get your buy or sell decisions don't get influenced by them. Many a times, we meet the managements after buying the stock, after our due diligence. We also meet managements of a lot of unlisted companies and a lot of unrelated sectors, because that's how you try and connect the dots. So, if you want to know about a kids garmenting company, no point speaking to the listed player. You speak to the unlisted player in a different region, and then you try to confirm whether what the listed player is saying is right or not. And that will give you a better opinion. So we meet a lot of managements, but not necessarily the listed managements. We meet listed managements, but a lot of times we meet them after buying and not before buying.
Or it is for more like understanding their business.
Correct.
So that will be the only point. Got it. So, and one more question, one common question that every investor has these days is that, every fund manager whom, coming on to camera or giving a statement, they're all bullish about India growth and India growth story. But, but the data is not supporting it. Like, for example, GDP slowdown can be, or it can be the earnings slowdown. So still, and they find India to be more attractive. So what are your views on it?
So it's always been a bottom-up story, Akshara. So it's not a story where you try to take a top-down view, and especially in this market, like I mentioned, it's not really going to help. You have to be very, very specific in terms of where you're allocating money. Special situation, market share gain, capex mispricing, these type of themes really help in trying to find mispriced opportunities. So we have to focus on that. Of course, being in mid and small, it gives us the advantage to keep focusing on that. The macro is something that people with billions of dollars have to kind of worry about as they allocate into various countries, etc. But when you're focusing purely on mid and small, we have to be thorough on the micro side with our homework, and the opportunities that can come about. So to that extent, we kind of in a way give probably a 15-20% weightage only to the macro side of things, and we focus on micro. So we've not really taken significant cash calls based on the macro side of the market, and we are still able to deploy money in these market conditions as well. We are able to find ideas in these market conditions as well.
Okay, so I'll take one question from the audience now. So Raman Das wanted to know your views on shipping and logistics sector.
So I don't have a very detailed view, but I know that with this new shipping bill and shipping being given an infrastructure status very soon, that's going to augur well both for the shipbuilding uh, industry. I think in terms of the number of ships and for our population, there's still a significant scope, and government is very keen on providing infrastructure status to the shipping sector. I think that would augur well as far as shipping is concerned. As far as logistics are concerned, I mean, you have various types of logistics. The companies which are into inland waterways uh, that show a lot of promise and that can show great amount of growth in the years to come.
Got it, sir. And that's a follow-up question like that. Many of them who are following to the Q&A, they want to appreciate your PPT. Following that, there's one person wanted to understand about the chemical sector and what are your expectation for this 2025?
Again, there are thousands of chemicals, so to again take a very blanket view is extremely hard. Uh, we own some, surfactant and pigment exposure. So we are quite positive about the surfactant and the pigment exposure as far as chemicals are concerned. We also are looking at companies where the market cap is close to the gross block of the company, and despite the correction, we are not yet seeing that kind of a situation in a lot of these chemical companies. So it's a very stock selective play. We have probably one or two chemical companies in the portfolio and not more than that.
Okay, sir. Thank you. Because to the benefit of time, let me take the one last question. I think this is a very common question every investor asks. While investing in small and mid caps, what are the things an investor should keep it in mind before investing in them?
The main thing is volatility. Number one, you have to be prepared for volatility, and you have to be prepared for scenarios where your stock doesn't do well, and you feel like as if the neighbor is getting very rich, and therefore you might try to exit at the wrong time when the cycle actually bottoms. So you have to be prepared for volatility, and you have to keep in mind that the businesses are much more stable than their stock prices. So just because the stock is down 20, 30, 40%, that doesn't make a business bad. And just because it's up 30, 40%, that doesn't make the business superior. The truth is always somewhere in between. Therefore, that is another key aspect. In terms of liquidity, your buying liquidity can be very different from your selling liquidity if you get a winner eventually. So if you buy a stock and you pay a significant impact cost of 5%, 10% to build your position, uh, and the stock is a winner after say 3 years, 4, 5 years. So the selling is not going to be as challenging as buying, because by the time the stock becomes semi-discovered or fully discovered, and therefore there is a lot more participation. So the key is to be in the undiscovered and the semi-discovered names and hope for them getting discovered. And one more point is on the, everything has a price. There's a lot of importance being given to management quality, which is of course a qualitative thing, but everything has a price. So an average company, if it is available at a bad price, one can still buy and make money on it. But if you buy a great company at a great price, you may not make money on it.
Okay, got it, sir. So thank you. With that, we have come to the end of the session. And also a lot of questions which have fallen on the around, I think 25 questions, it's still unanswered. So I will send you this via mail. I kindly request you to take time to answer these questions. And, these will be mailed to the respective people as well. And thank you, sir. Thank you for taking time and giving us such an insightful presentation.
Thank you so much, Akshara. Thanks to the viewers. Pleasure.